All right, Howard Ward is Director of Growth Equities at Mario Gabelli's Gamco Investors. They manage $35 billion in assets there, and Howard joins us on Street Smart now. Howard, thanks for coming to the show. Let me ask you about some of the stuff Andrew was just talking about. I mean, really down on financials, really down on tech. Obviously, his investment window is infinitely smaller than yours,
sure.
But he's using every rally as an opportunity to sell.
Well, right now we need to see improving economic data. The technicals are sort of driving the market. We went down to that 200-day moving average. We're bouncing off of it. But until we see a re-acceleration in growth, as evidenced in economic data, and until we get some resolution to the Greek crisis, which we've been dealing with now for the last year, it's hard to see this market really having any sustained rally. So we have a rally. To fuel it, you need better data, and you need some resolution to Greece.
I got to ask you about Greece. A lot of people have been coming out this morning saying, if we can just get evidence that they're going to kick the can further down the road. Do you need resolution there, or do you just need more time?
Look, it's very straightforward. There are three outcomes here. You can gift the money to Greece, which they don't want to do. You can restructure the Greek debt, which they don't want to do. Or you can kick the can down the road, which is what they're trying to do. So for the moment, we'll settle for kick the can down the road. That's all we can hope for. But let's not forget, we went through this 12 months ago. The May-June correction of last year was 16%.
Do you expect that much this time? We're down, I think, almost 7% now.
That's going to depend. The next 10 days, we get a lot of economic data. We have the two-day Fed meeting, a lot of economic data. Then we get the June payroll report for first week in July. In order for us to be on a sustainable path of growth, we're going to need to see these weekly unemployment claims on Thursday morning get back below 400,000. And we need to see the monthly payroll gains get back above 200,000. We're not there right now. We're not that far away. It's possible. But until that happens, I think you need to sort of play it defensive.
I want to talk a little bit about investor sentiment here. Cowen and Company's head of equities, John O'Donohue, talking about that here on Bloomberg TV. Listen up.
Sentiment numbers have come down to levels that we haven't seen in a very, very extended period of time here. I'd say since about 2004, 2005, which tells me that the level of pessimism in the market has reached a level where we could get a pretty good snapback rally if Greece gets their house in order.
So do you think, I mean, investor sentiment has been, you could feel how bad it is, and you can see it in the volume today. Do you think he's right there? And what?
I think it's a question of timing.
We need a resolution on Greece to turn that around.
I think stocks will be higher by year end. We'll get a resolution on Greece. And I think the economic data right now will probably get better, because we know that the Japanese supply disruption was a big part of our issue with our economic growth, with the soft patch. Yeah, we know that the weather was a problem. We know auto production is going to increase quite a bit in the second half of the year. So there's real hope that our economy will weather this soft patch and reaccelerate. But we don't have that data yet. And unless you're willing to make that bet, again, I think I would tend to be a little bit conservative.
What about, I wonder about growth stocks. I mean, you're in charge of growth stocks over at Gamco. So is this a tough environment?
It's been tough for a decade, and that's the whole point. And these stocks are dirt cheap. We've seen a compression of 50% in the forward multiples on this group, from about 26 times forward earnings down to about 14, selling at no premium to the overall market. It's a great time, but they make it cheaper if the economy doesn't get better. And so it's all, timing is everything in this business. It's been a 10-year run for small cap stocks, for value stocks, for emerging market stocks. At some point, that leadership baton will be transferred to large caps and to growth stocks, and hopefully that's imminent. Hopefully for me.
Howard, it's Adam Johnson down on the floor of the New York Stock Exchange. Goldman Sachs today lowers their GDP forecast to about 2%, joining three other guys who did it last week, as well as the IMF. So when does this thing turn around? Because you're making the case that it will, but I'm not hearing any kind of sense for when.
Well, I wish I knew precisely. But again, the next 10 days we get a lot of data, and then we get into the earnings season for second quarter earnings. And that's going to be very telling. The commentary and guidance that we get from corporate America in the first 3 weeks of July, I think is going to go a long way towards dictating the performance of this market for the next few months. The GDP numbers come down, but let me say this. Stock markets are a function of multiples and earnings. I have not seen a real material decline or any real negative earnings revisions for the S&P this year. We're still talking about roughly $95 in earnings for this year. I think we're going to see a multiple on that of 13, 14, 15. That can put the S&P above 1,300, 1,330, 1,350, higher than it is today. So I don't think there's a tremendous amount of downside to this market, but certainly if the economic news does not get better, it will go lower.
Well, and I want to talk valuations with Julie right now. Bloomberg has been crunching numbers. Some numbers show that stocks are not just a little bit cheap, Julie, but a lot cheap.
Especially, if you look at the longer term, you can look at price to earnings. We're the cheapest, in fact, by some measures in 26 years. And what's unusual here, and Howard, this speaks to your point, is that even as profits have been rising and are expected to continue to rise, stocks have been pulling back. You mentioned that $95 a share figure for the year. You're looking at about 18% growth. And, that's pretty good growth at the same time that stocks have been pulling back. So how are you going to get those two elements back in line again, if you will? I mean, is it going to be the profit reports? Because we've had profit reports, and that hasn't seemed to help.
It's a process. It takes a period of time. And I'm going to throw a little wrinkle into my somewhat bullish argument here, and that's coming 2012, which isn't that far off, you're going to see some tax increases, which I think are going to weigh on the economy. And I think going back to the Goldman Sachs downgrade to GDP growth to 2%, if we don't have momentum going into 2012, growth is going to slow at that point in time because you're looking at the Bush tax cuts are going to expire. The payroll tax cut, while they may extend it, they haven't yet. That's going to expire. So you have this fiscal drag that's going to exert itself on the economy, and that no matter what the growth rate is, it's going to be dampened by that. So we need the momentum. The process for stocks will continue over time. Sentiment is bad now. It's been really 6 weeks. Look, last week the S&P was up 4 basis points. I'm calling that down. It's been 6 weeks of essentially negative stock prices, and everyone feels terrible about it. It will get better. There will be a catalyst, but it's going to take a series of data points in order to get us there.
Almost 7 weeks. I don't think you can count a 1 point gain in the S&P as really breaking that streak.
I'm with you.
What do you think about where you put your money now? I mean, you rotate into defensive stocks. That's been the play for a while. Do you continue with that?
Until you see the improvement in the economic data, I think you do. I just don't think you're being paid to jump out of that defensive nest right now and to get more aggressive.
So you go to consumer staples, you go to healthcare, you go to utilities?
Yeah, I think you do. Because, again, you need two things to happen. Improving economic data, reacceleration in the economy, and resolve the Greek debt crisis. I'm taking it as a given that Washington will extend the debt limit and come up with a $2 trillion in savings package over the next 10 years.
Of course.
That's a given. I hope. Julie?
Howard, how do you find growth in defense, though? Because traditionally, those are not two things that you think of together, right?
Well, in a world of 2% GDP growth, growth is very relative. So if you're getting 8 to 10% growth in consumer staples and a dividend yield of roughly 3%, which is the case in many of these stocks, that looks pretty good compared to real GDP growth of 2 to 3%.
So you're getting paid to be defensive here while you have to sort of wait to get back into the growth stocks.
Yeah, and we've had a correction in growth stocks. Apple, Google, yes, technically they look like train wrecks, but there's real value here. And I believe that by year end, these stocks will be materially higher than they are now. I own them. I haven't sold a share. I guess that's been a mistake, but I really believe that the balance sheets are bulletproof. The businesses are strong. The earnings, most recent earnings and projected earnings, I think are going to be, strong double digits. So I think there's value there. There's value in energy. There's value in materials. There is value in technology. But there will be more value there if this economic data doesn't get better.
Sheila, did you?
Yeah, Howard, I hear what you're saying about going to the defensives and getting paid to wait, but is there an argument to be made that perhaps they've gotten ahead of themselves here? I mean, you take a look at healthcare, you take a look at consumer staples, top 2 performing groups in the S&P for the year. Are they getting too expensive now, even for the defensive investor?
No, I think many of these stocks are still available at PEs in the 10 to 15 range. And again, compare that to 10 years ago when the overall market was at 25 times earnings. We've had very little movement in the market averages so far this year. So the fact that they're market leaders, to me, doesn't mean that much. I think there is value here, and there's yield here, and we have investors that are starved for income. So it's a good place to go for that.